Hi, this is RAJAT BOSE here. Now we are going to present our 29th edition of Market Outlook, Stock Reviews and Stock Recommendation. Now we are going to present the Nifty. Nifty needs to be discussed, and especially this is a truncated week because Monday is going to be the trading holiday for Guru Nanak Jayanti on 27th. So it will be a truncated week from Tuesday through Friday. But also remember that this week is also the expiry week for the derivatives. So there would be a lot of action, and already the week gone by, we have seen quite a bit of movement, good movement on either side. How things are going to pan out, we would study that. Nifty has been range bound over the last week, especially for the last 4 days. The range has been pretty minimal. It was trying to clear the Gann angle that we had been closely following for the last couple of weeks, and this Gann angle is the third Gann angle from below, as you can see on the chart, on the daily chart. And this Gann angle, it was tested on 16th of November, and after that on Thursday last, or that is 23rd November, there was an attempt, but it could not clear the Gann angle. So that means that this third Gann angle from the bottom, counted from the bottom, it is the supply line, or it is the supply zone. The resistance is gradually upwardly mobile, but this Gann angle is significant Gann angle, because when you look at the weekly chart, you will see that the weekly chart shows 4 consecutive higher closes, but the moves within the week happens to be pretty small, because see, the last week it had been, the high was 19,875 and the low was 19,670. So you can see that it is a 205 point move throughout the week. That is the very small increments that are happening. But what is encouraging here is that, again, if you look at the daily chart of 1 year daily chart, you will find that Nifty is moving up very steadily, and the moving averages, especially the 9-day moving average, is clearly moving upwards, irrespective of the fact that there had been bearish crossovers, bearish death crosses that we referred to, and we thought that it would go down, but it is actually posting a good rearguard action. The bulls are coming back into action, but if they have to get past, if they have to really show their strength and move towards a new high, in that case what they have to do is they have to take out this Gann angle. And now this Gann angle value is around, say, 19,920 to about 19,950. So unless 19,950 is decisively taken out, this movement that is happening at the moment will not acquire the gumption to post a new high. And especially the zone between 19,900 to about 20,000, this would be a major problematic zone for the bulls, because a lot of supplies are likely to come. So as of now, unless we see that the 9-day moving average at 19,710, from there to about 19,484, where the 20-day moving average is located, and only if the Nifty takes out 20,000 mark, then it will acquire really strong bullish gumption. As of now, the bias is bullish. Now we're going to study the Bank Nifty. Bank Nifty has always been a problem for the last few months. and we need to look at what kind of signals the bank Nifty is emitting, whether the weakness will clear up or it is likely to continue, or we can see some kind of recovery in bank Nifty. All that, just keep watching. There can be some recovery. The last 5 days, of course, throughout the last week, it oscillated between 43,806 on the upside, that is the high of the week, and 43,230. Roughly, you can say that this is a 475 point range for the bank Nifty. For bank Nifty, the weekly range is comparatively smaller. However, one thing that we see here is that 1 year chart shows that there is a turnaround in the 20-day moving average, and 200-day exponential moving average has given the support, much needed support on Wednesday when it was violating the 200-day exponential moving average. At that point of time on Wednesday, it was ruling at 43,300, to be precise 43,301.85, and the day's low was 43,230.95. So that was the only test of the 200-day exponential moving average, and it provided ample support so that on Thursday and Friday, Bank Nifty actually posted higher closes. So we see two green candles. Of course, the 50-day moving average is still above the closing price. 50-day moving average currently ruling at 43,900, whereas the close had been 43,769. That is 130 points lower. Bank Nifty, if it fails to take out the gap between the 50-day moving average and the low of 16th of November, that was 44,064, and the current 30-day moving average is 43,900. So this 150 point kind of range poses a gap, and this gap needs to be taken out. Otherwise, the bank Nifty, the island reversal that it showed, it is still there despite the fact that there has been some recovery. But bank Nifty is comparatively much weaker than, say, Nifty and the CNX MIDCAP. So bank Nifty needs to be closely watched, and also please observe the movement of HDFC Bank, ICICI Bank, Axis Bank, State Bank, all these major constituents of the bank Nifty. You need to watch them to understand what is actually going on and what can be the movement, because I still feel that stocks like HDFC Bank or State Bank may show weakness after this recovery rally or after this pullback rally that is over. Once it is over, these stocks may again slide downwards. That is the implications given by the weekly chart. CNX MIDCAP is an index that gives us the sentiment reading of the retail people in the market. How are they behaving? Whether they are continuing to buy, whether they will continue to buy, or they are going to book some profits. All that we would study in the CNX MIDCAP. Despite the fact that the month has not come to an end and we are about to move into the final week of November, the next Thursday will be the monthly option clearing and futures settlement day, and this is a 5-week clearing. The Monday is a trading holiday, and there will be 4 trading sessions this week. But look at the monthly chart. The monthly chart shows that October had been a down month. That was some kind of a minor reversal signal, but till now, although the last week is still yet to go, last week of the month, that is the next week, starting from 28th of November, 30th November would be the monthly option and futures settlement date. So as of now, as at the end of the last week, the green candle is pretty strong and it is closing near the all-time high. The all-time high is 42,193 and the close is 42,050. This is the highest close ever made by the CNX MIDCAP in its lifetime. So after one down month, that is October, after 6 months of upswing, October has been a down month, and this month so far it is a major swing on the upside. The low is 38,738.70 for the month of November, whereas the high is 42,193. So it's more than 3,000 point run. This is the maximum span that we have seen over the last 8 months for the CNX MIDCAP. So CNX MIDCAP from the monthly chart point of view looks very bullish, unless of course it comes down and closes below the September close of 40,537. If it were to fall below that, then it will be weak, but we need to see how the next week pans out. But as of now, the indication is that it is pretty strong. Now, when you look at the daily chart of CNX MIDCAP, shows very small candles, and gradient of the uptrend has flattened quite a bit. So we need to be very watchful, and we need to see the 9-day exponential moving average, which is located at 41,644. That is something very, very critical. So 41,644, if breached decisively, this would signal a possible termination or at least a pause in the upswing in the CNX MIDCAP. Now we have come to our stock review section. This time also there would be 3-4 counters where we would be studying why are they there. We would talk about that, and you would get an understanding of some of the important stocks, how are they behaving. The chart that you see is the chart of Dixon. It is actually an YTD daily chart. YTD meaning that is from 1st of January till current date for the year 2023. Dixon we recommended at a very low level. It was late May when we recommended it. That was around 3200 levels. From there it has had a stellar run. Now what we see is that the Dixon, although it has not broken the 50-day moving average, the orange colored moving average is the 50-day exponential moving average, and that has been giving support not just in September but also in the month of October. In November it has not been tested, but it is now coming very close because it has posted consecutively 5 red candles and 4 of them on successive lower closes, and in the process it has broken down the 9-day moving average, 9-day exponential moving average, as well as the 20-day EMA, and now it is about to test the 50-day exponential moving average. What does it suggest? It suggests that it is showing some kind of distribution. It is showing a bit of fatigue, and this distribution pattern suggests that going forward, if it were to fall below, say, 5200 or say even 5000, then there is every possibility that the 200-day exponential moving average, which is currently ruling around the 4500 level, that might get retested. If one is a short-term trader, one might consider booking profits if you have profits. Fresh buying at current juncture is not warranted, at least till such time we get to know that 50-day will support and it will cross, it will bounce back and clear 5600, then strength will come back. At least see what happens at the 50-day moving average and the Bollinger Band level, lower Bollinger Band level of 5100. So 52 to 5100 is the major support for Dixon. Unless that gets taken out, it is not going to fall. But if it were to taken out, then 4800 or even 4500 could be a possibility, since there is some kind of a distribution that is going on at the moment. It is not consolidation, it looks like a distribution, and that would be confirmed once 50-day moving average is decisively broken. It is up to your choice, and do proper due diligence, understand, then only act on this study. And not just this study, the study that we have done so far, all the three stocks and the indices, act accordingly. Is the chart of Fine Organics. Few months back, I recommended this stock, and although it did move up after I recommended and it went up to 5000 plus levels, but after that the industry suffered a setback and fundamentals started deteriorating. What happened is that after the September quarter, it has a case for concern for most of chemical companies that their fortunes are on the downhill, and this stock is not an exception to that. In fact, it is also suffering pretty badly. The fundamental analysts, there is some kind of a consensus opinion about Fine Organics prospects, at least for the September quarter as well as the December quarter, or maybe going forward there could be more weakness. This is the reason why Fine Organics has seen this kind of a selling, but recently this downslide has been arrested, but it is still not very encouraging. Although the volume figures are pretty low, it is still not very encouraging that Fine Organics is going to post a rebound in the near term. But when I recommended this stock a few months back, I actually talked about a 2-year horizon. And from a 2-year horizon, or further away, that is 3-year horizon, I still believe that Fine Organics, but it's a very good company. Its return ratios had been pretty good. For a few quarters, maybe you will see that chemical companies like Fine Organics will suffer, but this company has in its grain to post a comeback, and it can move up. Of course, I must disclose that I personally hold some shares of Fine Organics, and at the time when I recommended, I also had the position, and I would continue to hold on to my position because I recommended, and then also I disclosed, and now while reviewing it, I'm saying the same. But I'm not saying that you would not get out. If you are a short-term player, if you can decide to get out, it is up to your choice. But this is not something that all hell has broken loose for this company. Review stock is NIACL, New India Assurance Company. This is actually a general insurance company, and it is a government-owned company. We have earlier, long back, we have referred to this counter, and it has, I feel that this stock has some potential. this stock has shown a major move on the last Friday, that was 24th of November, when it hit 20% circuit at 209. In fact, for the last week, it has shown major movement from a low of 156.20. It closed at 209. So it is more than a 50-point move throughout the week, and that's a 25% kind of a move. So as you can see that the 9-day exponential moving average is at 169. So it is cool 40 points above the moving average. The movement is definitely it is an overstretched movement. But you need to appreciate one thing for NIACL is that it has been in a range bound situation for a long period of time. For several months, it has spent in a narrow range of, say, between 100 and 130, and only a few days back it moved above 140, 150 resistance zone, and after that it has moved very strongly. If it were to maintain above 200, then definitely you would see a good move on the upside, and this kind of a pattern on the weekly chart suggests that this is the beginning of a long move, and this is corroborated once you look at the monthly chart. The monthly chart gives you an indication that since late 2019, it has never moved beyond 200 and closed there on a monthly chart. So this suggests that the NIACL is now the next candidate for a strong upswing. Last week we reviewed NMDC, and now this week again another PSU, NIACL, is giving a clear signal that it is in all probability headed much higher from here. It may take time, but it will give a very good move. So NIACL is a stock to watch. If you have liked my presentation, please press the like button. Subscribe to my channel. Share it among others on the social media as well as on other places, to your friends, through emails, whatever.